All right, what's up, guys? I hope you're doing well. Just wanted to continue going on with the monetary policy report. This one up with some data reflecting the expected Fed funds rate that the market kind of implies. So we'll just go ahead and head right into it. Go here, screen share, and then I will. Here, so if it's bigger. Okay. So the market-based expected path of the federal funds rate steepened notably amid news about the labor market recovery, rising inflation pressures, and the accompanying prospect of tighter monetary policy. And the data reflecting this sentence is in previous videos, just from when I went further up in the policy report. If you can even see from the sidebar down here, this is a very long part one to the report. And so it's a lot of data and it's amazing. So market-based measures suggest that investors anticipate the federal funds rate will soon begin to rise and move above 1% in the middle of this year, about 2.5 years earlier than expected in July. And we see that down here, we have this black curve, which is the market implied federal funds rate for as of July 9th, 2021. And then the blue line as of February 2022, or February 22 of 2022. It's a lot of twos. But yeah, we're looking at 1% hitting basically like maybe mid 2022 or before, sometime between now and say June-ish or so, it seems. Whereas in July they weren't pricing it in until almost 2025. So you just see this massive spike, and then it kind of tapers off and goes down. But we'll find out. I believe that's happening relatively soon, or by the time this goes, it might have already happened. I don't remember. I think it's sometime this coming week. I'll air this one on Monday so that it's up there before it happens, or maybe as it happens. I'm pretty sure it's next week. You're kind of seeing the same thing with Treasury yields. All of them are starting to go right back up. Where we have the blue is the 2-year, 5 is the 10, this red line is the 5-year, and 10 is the 10-year. But one thing I noticed is there's this massive where they're all kind of converging right here. And also saw something interesting, and I know George Gammon talks about it a lot on his Rebel Capitalist show, on his the YouTube channel specifically. But the spread between the 10 and 2-year is a very good indicator of recessions, right? I believe I was listening to Lynn Alden as well, and she said there was an actual study done between the 10-year and a 3-month Treasury, and they found that they studied it 4 times, I think it was 3, and then that study was able to predict the next 4 times on the dot, and it's been right ever since. So there's that. Also see how closely they've been basically converged since 2019 to 2020, and then they're doing it again, which is not a surprise considering everything else we've gone over. Yes, across credit categories, corporate bond yields have risen substantially, and their spreads over yields on comparable maturity Treasury securities have widened moderately since early July. So I guess the reason why this is a big deal, one, they all follow kind of the same trend, which makes sense. They're all interest rates. But I think why the spread between them matters, I would assume it's because you're pricing in basically the risk of the interest rate is basically, it's kind of correlates, I would assume, to the risk of the corporation or whatever in the case of corporate bonds. Just because interest rates are the price of money. So it's like that's how much they are going to pay you for the risk in which you're placing your money for them with. So by the fact that the spread between corporate debt and government debt is widening would make me assume that people are seeing, or the market's implying, the an increase in risk in corporate debt. So either corporate debt's too high, which I'm pretty sure it's at an all-time high right now. I don't have a number for that, but yeah, that's basically, which also kind of leads to the whole recession thing. Because if people are pricing in like businesses and such to have too much risk, I mean, either they cut off the flow of capital and not invest, or they demand higher interest rates. And if if that keeps going, then the corporation won't be able to afford those higher interest rates on their debt. So they'll either have to deleverage somehow, which kind of goes to the whole point of recessions. Like, you kind of need recessions. Kind of cuts out all the dead wood and malinvestment. Else you just get a bunch of zombie corporations who can't pay their debt, but the only reason they're still operating is because they can keep borrowing. Sounds like the U.S. government. So since early July, yields on 30-year agency mortgage-backed securities, now we're talking about MBSs, an important pricing factor for home mortgage rates, increased in spreads over comparable maturity Treasury securities, widened moderately but stayed near the low end of their historical range. And that's in this graph right here, where we have our yield on the left on this axis, and the spread is in the basis points on the right. And basis points there's 100 basis points to a percent. So 0 to 100 is 100, or is 1%, and so on. So with this one, this graph is specifically, the yield is shown for the uniform mortgage-backed securities 30-year current coupon. Spread is shown to the average of the 5-year and the 10-year nominal Treasury yields. Okay, that's the average of them. Not really sure why. I guess the average in this case, and the points here probably wouldn't be too big of a difference, because if we go back up to this graph, we can see how close they are. So the average doesn't really change anything. But when the spread is like so wide, I could see where the average might actually have a significant effect on the spread. But I don't know. To be honest, I'm not too familiar with mortgage-backed securities. Like, I know what they are, but like, I don't like how that reflects in the markets and such. Haven't really thought about much. I know they're basically called like mortgage-backed sausages. And because they literally just package a bunch of mortgages together, and that's what they sell as securities. And I think through this, the Federal Reserve technically owns like 24% of U.S. mortgages or something like that. Something like that. They own a lot of them. So that's all for this post, or this video. Kind of trying to break these up into sections so they're not too long. But yeah, I guess the biggest takeaways are the spread between corporate debt and government debt is widening, and Treasury yields themselves are actually converging to a point. And if the 2-year and if the spread between the 2-year and the 10-year inverts, that's a pretty decent sign of a recession. Pretty sure it's been 100% accurate since it's been measured, but doesn't mean that it's going to be right 100% of the time. It just could not have happened yet. So yeah, and it seems like the market's thinking all interest rates are going up by a significant amount in 2022, at least, basically going from 0 to almost, I'd say 1.75%, according to this graph at least. It's probably changed since now, because a lot has happened since February 22nd. So anyways, that's all for this one. I hope you guys have